Hello, everybody. My name is Mark, and I am the stock market jobber, and I want to talk to you about why you have been losing money. And you probably may not even know why. Now, before we get into this, I just want to give you a little bit of my background because I have a lot of experience in the institutional trading world, and I've seen what makes some people successful and what makes people not successful. As someone who's in the institutional investment world for more than 20 years, I've overseen the trading of hedge funds. I was a market maker. I oversaw the trading of mutual funds. There's probably not too much I haven't done. But when I kind of quasi retired, I started thinking, like, what can I do to quote unquote give back? And I see a lot of the garbage analysis that's out there where it's everything from just sheer incompetence to people that are swindlers. And I want to teach at this point in my life, I want to teach new investors and new traders how to make money. Now, a lot of you might think that, oh, the great people or the great money managers like Mario Gabelli or Steve Cohen, who I personally traded directly for, have like some kind of secret system or, this holy grail that always works. And that's not the case. The best traders in the world take losses, okay? The best traders just don't take big losses. It's like a basketball team, right? Tonight's the NCAA tournament. The best teams are going to miss some shots. It's just part of the game. So let's go into this. And it really comes down to the fact that most retail traders fail because they don't understand how important the psychology is, investment psychology is. When you have money on the line, it messes with your emotions. And when you make emotional decisions, whether it's in trading or any other aspect of life, well, good chance it's not going to work out so great. So why do traders fail? And ask yourself if you are the victim of any of these. And if you are, don't worry about it. I'm here to help you. I'm here to help you. I don't want to tell you what to do. I want you to learn how to teach yourself or how to come up with your own trades. But emotions, let's think of our emotions. Why do traders fail? They guess, or actually, I've heard that 90% of new traders fail, new retail traders fail. And that doesn't surprise me. They guess. All right, well, you know what guessing is. Hey, I'm going to buy this stock. It may go up, it may go down. I'm going to buy this option. It may go up, it may go down. That's just guessing. If you have a valid reason for buying it, that's different. Oh, this particular stock is really oversold. It's at a support level. Stocks that are oversold and get to support tend to bounce. So if I'm a stock trader, I'm going to look at the stock. If I'm an options trader, I'm going to look at the options. So guessing, all right? We don't want to guess. Sentimentality. This is when traders fall in love with an idea. Oh, I bought Bitcoin and I put 10 grand into it and I made 100 grand and I'm never going to sell it. I love it. Which was kind of ridiculous because a lot of, when Bitcoin started to fall apart a few months ago, there were people saying, I'll never sell it. Well, selling is just as much part of investing as buying. It's got to be both, right? Sentimentality. These stocks are not your friends. They don't care about you, and you shouldn't care about them. Just like a carpenter doesn't love his hammer. I mean, if a carpenter fell in love with his hammer and started taking them on, you know, apple picking in the fall or taking them out to dinner, it'd be kind of weird, right? A carpenter shouldn't fall in love or get sentimental about a tool. The stocks are tools that traders use. Now, the sentimentality, people, especially if people are new, right? They buy something, it goes up huge, they make a lot of money, they think this is easy. I'm never going to sell this stock. And you're going to lose money. That's sentimentality. Over trading, okay? This means people trade too much. It's okay to stay on the sidelines. If you don't see an idea that's compelling or that you have confidence in, you're better off just not doing anything. There's nothing wrong with being out of the market for a few days. It really kind of is surprising to me how a lot of newer traders or retail traders feel as though they need to always be involved. The best traders have the patience that they can stay on the sidelines and wait for something really good to come along. As a matter of fact, one of our students is got a really good analogy, which I never thought about. It's like you fish when the fish are biting. If the fish aren't biting, well, you can go throw your fishing line into the pond there, and you're not going to catch anything. Mistaking luck for skill. We saw this a lot with the Reddit craze 2 years ago. These people bought stocks, it was a bubble, it went up, right? And they thought, oh, gee, I really know what I'm doing. It's kind of weird because trading is like, seems to be the only profession that people that don't understand it think they can just show up on day one and be really good without ever having any kind of lessons or education. That's why I'm glad you're listening to me right now, because if you are, you're someone who wants to learn. And just like any profession, like if you want to be a carpenter, guess what? You need some to spend some time learning. And it's the same thing with trading. But this investment psychology class is probably the most important thing that there is when it comes to trading. I mean, the markets move based on investor psychology. They're not moving based on what they're saying on CNBC or Fox Business News. They're just moving because investor perceptions change 98% of the time. Thinking there's a holy grail or perfect indicator, there's not. It's like I said, the best traders take losses. I just talked about the financial media. Basically, they suck. They try to put every single little move in the market, or they try to make it sound like it was from some fundamental or ulterior thing. And that's not it. 98% of the time, of course, I can't quantify, but I would be willing to say 98% of the time, the market is only moving because of people's psychology. The media, they're wrong, blah, blah, blah. Perception biases, right? And we're going to go into those in a few minutes. Not having a plan. Hope is not a plan. As a trader, you should never use the word hope. You should never use the word luck. Get those out of your vocabulary. The best traders have plans. Now, are the plans perfect? No. But what happens is it helps them from not guessing. If you have a plan, it's like I said, it's not perfect, but it keeps you from guessing. So it makes the emotional response not as powerful. Not understanding investment psychology, which is what we're talking about now, and not understanding risk management. Now, these two come right together, and we're going to go over that a little bit more. Now, here's the problem, right? Fear. People get afraid. If you think you're going to lose money, you experience fear. And fear inhibits rational thought, right? Now, 20,000 years ago, if you were hunting a saber-toothed tiger or a saber-toothed tiger was hunting you, fear was a good evolutionary response. It makes you stronger, it makes you faster, it makes you laser focused. But when you're trading, these are things that make you make mistakes. Now, the worst things that traders can do is to sell their winners too soon and to hold on to their losers for too long. And it's because of the same reason. It's fear. Someone buys a position, they start making money. It's maybe 20% away from their target, and they just say, you know what, forget this. I'm just going to take my profit and be happy. And then they do their trade, and then it goes to their target, and they leave money on the table. The other thing is, all right, well, fear of taking a loss on the downside. I bought this stock, it's down. I don't want to take a loss. I'm just going to hope it comes back. Remember, hope is not a plan. So we have to understand fear, okay? Makes the traders do the two worst things they can do. Close out winning positions too soon, hold on to losers for too long. And we're going to go into that a little bit more in a few slides here. What is the secret to success? Well, it's pretty much the opposite of all the stuff we talked about for why people fail. There are 3 stages of a trader, and I'm hoping that you are in this third one here. The first stage of a trader is they want to be told what to do. This is the guessing. You go into some chat room, you look at some pundit or quote unquote expert on CNBC. You think like, oh, I got money, I want to make a trade, I don't know what to do, oh, I want someone to tell me. Okay? People end up losing money because that's basically guessing. The next phase is number 2, and this is where most people kind of fail out. They try to develop a perfect or infallible model or system. They think that the great traders like the Steve Cohens, the Paul Tudor Jones, Jesse Livermore, they have some super secret system, okay? The Holy Grail, and they don't. The difference between these incredibly successful traders and the traders that aren't successful is they understand that psychology is important. So people lose money in stage 1, people lose money in stage 2, people start to make money in stage 3. When you understand how important psychology is. And that's why I'm giving this lesson right now. The secret of success is understanding this. The secret of success is understanding that humans have not evolved in a way that's conducive to managing money because you experience fear, and fear makes you do things that are dumb. Now, what's the secret to success? Well, understanding this, having a well-defined plan, which prevents you from guessing, emotional detachment, like I said, you don't want to get sentimental, you don't want to fall in love with your stocks, knowing when to stay out of the markets. This addresses overtrading. It's okay to be on the sidelines. If I tell people this a lot, I have a lot of people that call me up and say, hey, Mark, blah, blah, blah. I got this position. I don't know what to do. What do you think I should do? And my response is always, if you're not sure, just get out of it. If you're questioning yourself, just get out. You can always get back in. But if you're not sure, you're just guessing. Focus on making money and not being right. It's another key to success. Now, this is a little counterintuitive, but let me just give you an example. Say a stock is down really big. It's gotten to, say, $50. It's oversold. It's at support. Stocks that are oversold and at support tend to bounce. Well, if you just go in and buy it at 50, you're kind of guessing, right? If you wait for the reversal to happen, you're not guessing. I mean, something that's oversold and at support can still keep going down. It happens all the time. If you wait for the reversal, well, you're going to put the odds in your favor. Now, what do I mean by not being right and making money? Well, say it gets to 50 and you say to yourself, all right, well, if it gets back up to 52, I think it's going to keep going higher. So you go in and you buy it at 52. It goes higher. You did a good job. Well, you know what? You can't second guess yourself. You can't say to yourself, all right, well, you know what? I should have bought it at 50. Let's just go back to basketball now that we're in the NCAA tournament, right? The best teams in the world are going to miss shots. The only thing that matters is who has more points on the board at the end of the game. It's the same thing with trading. It doesn't matter. It's not about being perfect. The only thing that matters is your value of your brokerage account going up or down? And we want to go up, obviously. So focus on making money. Don't worry about being too precise, too exact. It just can't happen. Now, let's talk about the herd behavior or the bandwagon bias, because again, this is a big part of psychology. You ever notice how when you're driving down the highway and you come to a toll booth and there's like 50 cars going into one lane, and then you get online and you look around and you see, oh, gee, that lane up there has got a green light, but there's no cars in line. So, you know what? I'm going to break away from this line here and I'm going to go drive through that. And I'm going to save myself 20 minutes. Well, the people who get online and just sit there like herd belonging zombies, they're the people that lose money in the market. The people that can look around the crowd and see, oh, wow, that green light, there's no cars there, I'm going to go. Those are the people that make money in the market. Now, we're not islands. You might think your thoughts are your own, but a lot of times they're not. A lot of times they're from some kind of external stimuli. Like, for example, you're in some chat room or some Discord. I don't even know what Discord is, but I hear people talking about it. But you're in some chat room, you're in some Discord, and it seems like everyone's getting on the bandwagon, everyone's buying XYZ. You think, oh, gee, I should buy XYZ. Well, why are you sucked into the herd? Well, because it's safety in numbers. It's an evolutionary response. Once again, remember, people have not evolved in a way that is conducive to making money. Now, I'm not saying you're ever going to become like some kind of Buddhist monk with complete emotional detachment, but just having an awareness of this, a self-awareness of this, really helps. Ask yourself, why am I making this trade? Do I have a valid logical reason for making this trade, or am I just guessing? Am I just doing it because some nebulous person I met in some chat room somewhere is telling me to buy it? All right. So we have to understand, and I can't say this enough. If someone actually asked me, and I do get asked all the time, what's the ultimate secret to trading? It comes down to one sentence: understanding that humans have not evolved in a way that's conducive to making money. Successful traders understand psychology, and emotion. Unsuccessful traders think there's like some secret system, okay? And what happens when they lose money? Remember we talked about mistaking luck for skill? Well, guess what? Think back to the whole Reddit thing and Bed Bath & Beyond and GameStop. Well, unsuccessful traders that lose money, they say, oh, gee, it's the market makers are rigging the game. It's the hedge funds are rigging the game. Guess what? I was a market maker. I oversaw the trading of probably 15 different hedge fund strategies. That's not how it works. Market makers and hedge fund traders do not go to work every day thinking like, how am I going to take advantage of the little bit? As a matter of fact, you can check out our market lesson here. Go to market lessons, and I talk more about what hedge funds really are, what market makers really are, what dark pools are, what algorithms are. Okay, let me go to the next thing here. So this is more about, the herd mentality. Think about it, right? You're rooting for a particular team of whatever your favorite sport is. Say it's NCAA basketball and it's UConn because they're going to go all the way. Well, someone comes into the bar you're at or the restaurant you're at, they're wearing a UConn jersey. You feel this kind of bond with them. You don't even know them. They could be an axe murderer. But goes back to their safety in numbers. Happens with music, it happens with religion, happens with fashion. Okay, let me move on. So perception biases, we talked about the bandwagon bias. Confirmation bias, okay? This is another thing that people have that makes it difficult for them to make money. And it happens in other areas of life as well. Confirmation bias means you tend to give too much credence to people that have the same idea as you and ignoring contrary evidence. For example, you buy Apple. You think it's a good time to buy Apple. Some analyst comes on TV, and hopefully you're not watching TV anymore to get your trading ideas, but let's just say hypothetically in this situation you are. Some analyst comes on and they say, oh, I think Apple's a great buy. And you naturally think, all right, well, this person is really smart. They agree with me. Fine. Maybe they're saying stuff that isn't right, but you just want to confirm your opinion, so you agree with them. Now, say someone else comes on, excuse me, and they say you shouldn't buy Apple. Well, confirmation bias is being like, oh, I know this guy or this person, I'm not going to pay attention to them. They don't know what they're talking about, but they might be making some really valid points. Confirmation bias is something that not only happens in the stock market or the financial markets, but in other aspects of life. The anchoring bias, making decisions based on the prices. Did you know that most people, when they go to a nice restaurant, they pick the second highest priced item on the menu? Because they look at the first highest priced thing, and when they look at the second highest priced thing, they think, oh, gee, that's that's got to be a good deal because it's cheaper than the first highest price thing. So a lot of restaurants that use science in their marketing or in their operations or whatever you want to call it, they make it so the second highest priced item on the menu has the highest return, or it's the most, they get the most profit out of it. Saliency bias, thinking this time it's different. This is, if we didn't have saliency bias, we wouldn't have market bubbles. Now, we saw the Reddit stock bubble, we saw the crypto bubble, we saw the cannabis bubble, all within the last 5 years. Why were cannabis companies at $300 when the company is losing hundreds of millions of dollars a year? Well, people start to say, this time it's different. When people start saying this time it's different, it's time to pay attention. Now, a good example of this was back in the later part of 2021. We saw, some of our students or some of our subscribers here saw an article that was written by someone at Bloomberg that said, oh, the rules of the VIX have changed. Whenever you see something like that, it's people are saying this time is different. The rules of the VIX had not changed. It's just that the person who wrote the article didn't understand how the VIX works. The VIX is called the fear index, and that's kind of a misnomer because the VIX is kind of the price of insurance, all right? Now, if the VIX is really high or the markets are really crashing or getting ugly, well, some investors are willing to pay a higher price for insurance. So the VIX goes up. Well, guess what? Suppose the market is in a bubble and people are euphoric. Well, a lot of investors are going to be willing to be afraid or going to be afraid that they're going to miss out, and they're going to be willing to pay a higher price to get insurance too. Sorry, everyone, it's my cough. But so the VIX, not only could it be the fear index, it could be the euphoria index. So this is the saliency bias. If we didn't have saliency bias, we wouldn't have crashes, we wouldn't have bubbles. We talked about some sunk costs and sentimentality. All right, paper trading is overrated. Now, I think there's a place for it, and if you're going to develop a strategy, it could make sense to it makes sense to get it out on paper, come up with something that you're comfortable with. But until you get real money in it, it's not going to really give you an accurate idea of what's going on. Wall Street is full of people that are running around with these great paper trading systems, these great back tests. Back test is when you say, all right, well, had I implemented my strategy 5 years ago, this is what would be my returns. So paper trading is important to develop a system, but if real money isn't on the line, you're not going to experience the psychology. Think about this. Your system tells you buy 1,000 shares of this stock at $10. If it gets to 15, sell it. Okay, fine. So on paper, you buy it, it goes to 12, it goes to 13, it goes to 15, and you're like, all right, well, I just sold it for 50% profit. This is easy. If it goes to 9, I'm just going to get stopped out and take my small loss. Fine. Now, suppose you had real money in it and you actually put 10 grand. 10 grand is a lot of money to me, to you, to anyone. Stock goes up to 12. Even though your target is 15, you start thinking, oh, gee, I'm up $2,000 here. I'm up 20%. Okay, well, I'm going to hold on a little bit longer. Then it gets to 13. And you say, you know what? Whatever. I'm afraid, I'm experiencing fear that I'm going to lose this profit. It's 3 grand. I'm up 30%. I'm going to take it. A lot of people say they're never wrong with taking profits, but that's actually a real misnomer. Sometimes you shouldn't take your profits. You sell it at 13, you make your $3,000, then the thing goes to 15, and guess what? You left $2,000 on the table. Because when you have real money involved, your emotions come into play. If you're just trading on paper, they don't. The secret, actually, it's not even a secret. The reality or the fundamental reason why people can be successful in the markets is because they understand the psychological response that people have. Same thing on the downside, right? All right, on paper, oh, it got to 9. All right, I'm going to take my $1,000 loss and move on to something else, right? Like Mark says, all traders have losses, blah, blah, blah. Well, now suppose you have real money in it. You put in 10 grand, now it's 9 grand. You start thinking, oh boy, I lost $1,000. I'm going to hope it comes back. You're using that word hope. Good traders never say the word hope, at least in relevance to their trading. They might hope about other things. Like right now, I hope my daughter dumps her boyfriend, but that's a whole nother issue. And at stockmarketjobber.com, we don't really do child psychology, but whatever. So anyway, then gets to 9. You're like, I'm down a grand. Oh man, this is real money. I lost $1,000. This sucks. I'm going to hold on to it and hope that it comes back to my level so I can get out at break even, right? And also, someone might not want to take the loss. It's also not about the money. It's about the self-image or whatever. It's like, all right, well, I don't want to admit to myself that I was wrong. So paper trading, there's a place for it, but it's overrated, okay? Don't get too caught up on it. Market sentiment is the aggregate psychology of investors. Now, it sounds kind of counterintuitive, but think about it. If the vast majority of investors are bullish, this is actually bearish on the market. Why is that? If the vast majority of investors are bullish, they've invested all of their funds. The market runs out of buyers and there's no one left to push the prices higher, right? This is the famous story is with Joe Kennedy when he was on his way to work. The shoeshine boy started giving him stock tips, and he went to work and he sold all his stocks. And then the market crashed, and the rest is history. Now, I don't think that Joe Kennedy would dislike shoeshine boys, but I think what clicked in him was like, oh boy, if people who aren't buying stocks are buying them, there's no one left behind them to push the price higher. I had a really similar thing happen here, and going back to the end of 2021, right when the market was at a peak. I had a plumber come over, and he was a young guy, probably about 30, and he saw my screens and everything. He asked me if I was a day trader. I told him what I did, and he was telling me how one of his friends left plumbing to become a day trader, and another one of his friends left being an HVAC person to become a day trader. That was the absolute peak and top of the market. Now, I have nothing against plumbers. I have nothing against HVAC people. But when people who aren't typically buying stocks are buying stocks, they're the last in the line. They're the last in the food chain. The market runs out of buyers, and the only place it can go is lower. It's the same thing on the downside. If people are really panicking, I mean, Warren Buffett gets credit for it, but I think people have been saying this since markets have started. If if the vast majority of investors are freaking out, guess what happens? They sell their stocks. The market runs out of sellers, and the only way it can go is up. So this is what we refer to as market sentiment. There is there is psychology illustrated on every chart. Here's a chart of Caterpillar. I just picked a random stock. We can see this on a lot of different things. Now, a couple things here, right? A level that was resistance became support. Resistance becomes support. Why does this happen? Seller's remorse. There are investors who sold who regret doing so when the price went lower, and they tell themselves, I am going to. There's investors who sold and they regret doing so when the price goes higher, and they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So if you have enough remorseful sellers placing buy orders at the level that was resistance, the resistance can convert into support. Seller's remorse, okay, turns resistance into support. We can see this on a lot of charts. Look down here. Support converted into resistance. Why does this happen? Well, it's the opposite. It's buyer's remorse. There's people who bought here who regret doing so when the price goes lower, and they tell themselves, if I can get out at break even, I'm going to. So when the price gets back up to their buy price, they place their sellers. If you have enough remorseful buyers placing sell orders at the level that was support, it can turn into resistance. So once again, we're looking at a chart. We are looking at human psychology. Seller's remorse turns resistance into support. Buyer's remorse turns support into resistance. Now, let's look at something else here. Why, when something gets to resistance, does it tend to sell off quickly? Well, a lot of the investors who want to sell start to get the sense that, oh, gee, there's other sellers around. There's other sellers lurking on the sidelines here. And they start to get worried that they're not going to be able to sell. If they're not offering their shares, or if they're not willing to sell at the lowest price of any investor, well, the buyers are just going to go to whoever is. So they start to get worried, and someone might say, all right, well, I'm going to sell at whatever price this is, probably about 225. Someone else says, oh boy, they're willing to sell 225. I'm going to go to 224. Someone else says, I'm going to go to 223. And we start this snowball effect. And this is psychology. There's nothing going on here with the fundamentals. Forget about what they're saying on CNBC. Oh, Caterpillar down on fears of, the Turkish lira. Actually, when I was a hedge fund, when I was an institutional trader, we always used to say that, right? Because one day on CNBC, and I used to not let people watch CNBC on my trading desk, but I guess for some reason it was on. They were just like, oh, the market's up on concerns of the Turkish lira. This is not. This is why you shouldn't even pay attention to the media. The market's down because of human psychology. People are getting freaked out. The sellers are getting freaked out that they're not going to be able to sell their shares. Now, when we get to support, the opposite happens. Investors start to think like, oh, gee, there's other buyers lurking around. That's why the price isn't going any lower. I'm afraid I'm going to miss it. I need to pay a higher price. If I'm not willing to pay the highest price in town, the sellers are going to go to whoever is. So the buyers start to pay higher prices or be willing to pay higher prices than other buyers. So we get this snowball effect. So right here, we're not looking at astrology, we're not looking at tea leaves, we're looking at psychology. Investment or seller's remorse turns resistance into support. Buyer's remorse turns support into resistance. Things sell off when they get to resistance because sellers are starting to get afraid and they undercut each other. Things or markets tend to rebound when they get to support because the opposite. Buyers are worrying that they're going to miss their opportunity and they want to pay higher prices. So if you want to understand how to be a successful trader, you have to understand psychology. It's really the be all and end all of trading. All right, so here are some famous quotes. We're going to post this in PDF form on our website, and hopefully in the next few days, and you'll be able to print it out. But we see the same things here over history, right? Jesse Livermore was a great trader back in the 20s. Listen to this. Remember when I told you shouldn't overtrade? It was never my thinking big that made money for me, or it was never my thinking that made the big money for me. It was sitting. Got that sitting tight. That means stay on the sidelines until you see something that's really compelling. Martin Pring, he's still around. Beating the market is not difficult. It's beating ourselves. Don't try to buy at the bottom and sell at the top. This goes back to what I was saying about it's not about being right, it's about making money. It's Bernard Baruch. This is probably a 100 years old quote, but the great traders say the same things because maybe the names have changed, maybe the companies have changed, but you know what hasn't changed? Human psychology. So the same stuff that happened 150 years ago is happening now. Why do you really want to trade? Are you doing it for entertainment or are you doing it to make money? I mean, ask yourself that. You should treat trading like you treat accounting if you really want to make money, because that's what we're doing. Accounting, when you file your taxes, you want to pay the least that you can. Well, if you're trading, you should kind of look at it the same way, thinking, how can I make the most that I can? And here are some more great quotes. I like this one here because I work directly for Steve Cohen, and he could be the greatest trader literally in the history of trading. The guy's returns are just unbelievable. But this is a quote from him. All traders have habits that help them back, or traits that hold them back. Traders have to face their demons. Bad traders blame the market or bad luck, or hedge fund traders or market makers. It's neither. It's just bad habits. Paul Tudor Jones, another great trader. Don't be a hero. Don't have an ego. Always question yourself and your ability. If you ever feel that you are very good, you're going to get crushed. Don't be too concerned where you got into a position. The only relevant question is whether you're bullish or bearish. Remember what I said? If you're not sure, it's a good idea to get out. If you have a losing position that is making you uncomfortable, get out. You can always get back in. All right, everyone. So that's about it. I just really want you to understand that if you want to be successful, don't blow me off, okay? Don't think like, oh, this guy doesn't know what the hell he's talking about. I'm going to come up with some super secret system that works. Well, maybe you can, and if you can, guess what? I'll subscribe to your website. But I've been doing this a long time, and I'm pretty confident that I know what I'm talking about. And I know it's not easy, but you got to focus on yourself. You got to be introspective. You got to analyze your mistakes. You got to analyze your wins. All right, I guess that's about it, everybody. Thank you for coming into Stock Market Jobber, checking out this, what I think is probably the most important video of trading you will ever see, and I hope to see you soon. Thank you.